For quite a while, I've suggested to the owners of U.S. private contract and component advanced manufacturers that they make an active choice about either investing in the future of their company, bringing on equity partners to do that with them, or divesting. There are several simultaneous factors changing the market. Otherwise, circumstance may do that for them. I've spent a lot of time analyzing this business to the point where one of the doors in my office is covered by a strategic and functional mapping of the industry. COVID-19 has necessitated all of us do some things differently. So this presentation is available in a socially distanced online version. Components of it apply to most private U.S. middle market, later stage companies, but it's really geared towards low volume, high mix, advanced manufacturers, those that would hold ISO 9001 or AS9100D quality certifications, but especially geared towards medical device manufacturing, i.e. those that would have ISO 13485. I'll use a couple of standard abbreviations in here: CMOs for contract manufacturing organizations, and EMS for electronic manufacturing services. Let's get started. COVID-19 was declared a global pandemic on March 11th. This presentation predated it, but changed accordingly. Obviously, some things have changed in the short term, but long-term trends mostly not. It's the longer-term prospects for a company that really matter if they can survive the interim crisis. The better prepared a company is for future growth, the less the impact of recent revenue and earnings declines due to COVID-19 may be on their valuation. First, for context, who are we and how can we help? We offer smaller to mid-sized companies, mostly but not exclusively U.S. companies, the advisory services described on the slide, which would tersely be described as valuation, mergers and acquisitions, debt or equity financing, and capitalization activity. We only serve corporate clients and don't offer any retail stock brokering. Our work has spanned multiple industries, and we have people with deep experience in several. Personally, my experience spans healthcare, medical devices, software, semiconductor test and measurement, business services, and now focused on how advanced manufacturing is being transformed by the many forces I'll now discuss. Of course, the first priority is ensuring that the company has adequate liquidity and that solvency is not in question. In case it's helpful, I'll draw your attention to an article I wrote titled 16 Immediate Actions Company Owners Should Take to Protect Their Business Financial Health During COVID-19. The right side of the slide lists the 16 different topic headings. If you go to thomasnet.com and search my name, Dickinson Bransford, you should find it readily. Let me be clear about the focus of this presentation. It's to describe the forces impacting your wealth as the owner of a company described earlier. It's very bottom line oriented, the bottom line being your future wealth and lifestyle options. It's designed to prompt thought and shareholder discussion, so please feel free to share the link with your board. It of course provides critical input to company strategic planning, capital and operational expense planning, and shareholders' personal wealth planning, all three of which in a private company form a triumvirate like three legs to a stool. If you are considering or open to a transaction, starting the process now may be the best time in the next 6 to 8 years. I emphasize the word starting because that infers being prepared to go to market, even if we agree to institute market value enhancement initiatives before actually doing so, or just test the waters. In any market, at any time, the company which is prepared and ready to be marketed for sale or investment will transact at a higher valuation than one which is caught off guard and responsive to unsolicited offers. Being ready means avoid having to get ready. But in no case does a transaction happen immediately. This number predates COVID, but 84% of lower middle market private transactions managed by professional advisors like investment banks were closing on average between 5 and 12 months after beginning the process, with almost 60% taking 7 to 10 months. The first month, or few, is almost always dedicated to preparation. There are 9 factors which challenge your equity value and 6 which support it. This slide summarizes those factors, and the rest of the presentation will delve into more detail about each. It's broken into factors which generally would detract from your equity valuation versus those which are supportive of a higher valuation. From this high-level vantage point, it's easy to see that there are many important considerations beyond just whether we're in a recession now. If you stick with me for the rest of the presentation, I think you'll probably learn some things you didn't already know and gain some new perspectives on things you may have been at least peripherally aware of. Among them, at the micro level, I'll discuss some technologies in your industry that you may not be aware of or thinking enough about them. I'll discuss the M&A market and the influence of venture capital and corporate venture capital on contract manufacturers. At the macro level, I'll discuss long-term influences of the economy, population demographics, and some geopolitical winds of change. Note that 2 points, innovation tidal wave and growth forecast, are italicized. That suggests the point could either be adverse or supportive, circumstantially dependent upon the company. We start out with the adverse factors. We are in a deep recession that could last many years. Let's hope for the best, but prepare for the worst. We already knew that U.S. manufacturing activity was declining well before COVID-19, according to the Institute for Supply Management. This slide shows a period from the end of 2018 to the end of 2019. We crossed over from manufacturing expansion to contraction exactly a year ago, July of 19 to August 19. This scale shows 50 as expanding and under 50 as contracting. How long will this economic downturn last and how bad will it be? Well, obviously nobody really knows that, but we do know the drivers of it. Biology, medical science, human behavior, and the inherently unpredictable innovation process as nudged along by governments, investors, and unprecedented collaboration among 1,000 scientists globally, with about 160 or so vaccines or treatment in the development pipeline, one of which is at least fairly likely to go into final 3rd stage clinical trials this September, the Oxford University AstraZeneca vaccine. But there are several others. On the other hand, nobody's been able to develop a vaccine for HIV or even malaria. And there's increased discussion in the virology community that it just may stay with us like the common cold and have to be treated upon infection. So both optimists and pessimists have something to work with here. One should plan for this chaotic new normal state of affairs to last for multiple quarters at least. And the longer it takes us to reduce our transmission rate, or flatten the curve, as they say, short of a miracle drug, the more likely that is to be in years, not quarters. The so-called Spanish flu of 1918, so-called because it actually originated in Kansas, not Spain, surged in 3 waves before it just mysteriously died out. The second one in the fall of 18 killed more Americans than the spring wave had. Whether COVID will surge further in the fall is to be determined. And of course, what's also to be determined is whether we will flatten the curve between now and then. At least if it does surge, the medical community will be better prepared to treat it based on knowledge gained to date. As this survey indicates, economists were almost equally split in May on whether we should be reopening businesses. I'm referring to the time we're in now as the chaotic new normal. The sooner we realize that chaos and uncertainty is our new normal, at least for a unforeseeable period of time, and will be, then create adaptive mechanisms, the sooner we rebuild our lives and our economy. The Congressional Budget Office is generally a pretty reliable data source as it doesn't have a political axe to grind. It's bipartisan. As distressing as a decade to regain lost GDP is, I don't find it surprising based on prior comeback patterns and what we still have to accomplish to resolve the health crisis at hand. In my opinion, business owners who are hanging in, hoping for a quick turnaround, are unrealistic. And those expecting it to look like 2018, 2019 anytime soon, even more so. Don't confuse the real economy, this view on the slide, with the stock market. As we see daily, its stellar performance right now is altogether divorced from what we know to be happening to businesses and jobs. The longest economic expansion in history just closed, and with it, M&A value inflation. History shows predictable cycles favoring buyers, then sellers, followed by uncertainty and transition. Our economy was tipped into recession by a demand shock. In other words, the sudden cessation of demand. A textbook example of the converse would be a supply shock, like the 1970s oil embargo. Not surprisingly, the M&A market cycle suddenly shifted too. The private M&A market has moved in fairly predictable cycles for the past 40 years and is influenced by the broader economy as indicated by the GDP trend line and context notes beneath the years on the graph. It favors buyers, shown in red or pink, for a few years, then sellers, green, then shifts to a period of uncertainty, yellow, before repeating. It's not absolute, but the uncertainty in buyer-favored cycles tend to be around 3 years each, and external stimuli like the growth of the internet, dot-com crash, and COVID play a prominent role in shifting markets. The green seller's market cycle was nearing its end as we were already moving into the yellow uncertainty zone, but COVID did speed that up. Pre-COVID, the historic trend suggested that in somewhere around 2021 there would be a shift to a buyer's market for a few years, and then it would flip to a seller's market upcycle again sometime in the mid-2020s, 4 or 5, through perhaps 2028. So, in any case, that's a pretty good distance into the future for the many private company owners who delayed retirement or other next step in life plans while the market was so robust. I wonder how many are going to be willing to gamble that far out on the possibility that another seller's market will materialize then. In the past decade, M&A deal valuations continued to climb. Look at the overall trend line showing middle market transactions, enterprise value to earnings before interest, tax, depreciation, and amortization, otherwise known as EBITDA, multiple for the past decade. It's a pretty linear upward slope. While banks are likely to pull back in a recessionary environment, private debt funds were sitting on about $241 billion in investable assets globally as of last year and are likely to continue investing through any downturn. Therefore, debt financing is unlikely to dry up like we saw it happen in the great financial crisis of the last recession. As you can see from the first circle, most in a January finance community survey expected the seller's market to end this year or next. So many, if not most sophisticated investors and acquirers were already pricing the recession adversity into their perceived valuations. The second circle highlights that they were also concerned that the market was too generous in its valuations to the extreme. Why? Because higher prices extend the return on investment payback period. There's no risk cushion. Everything's got to go right for it to pencil out for an investor. Meanwhile, sellers had seen valuations continue to climb for years, and human nature being what it is to extrapolate that experience into the future. So the gap between buyers and sellers' expectations just continued to widen. Thus, M&A deal count was already falling well before COVID. But it may rise again for 3 reasons. One, just in general, exogenous shocks to industries and or markets typically spurs activity. if debt's available, as I just cited a minute ago, it probably will be, unlike 2009. The first phase of this is rescue M&A for cash-strapped companies to avoid a worse fate. The second reason is for the year prior to the past 4 presidential elections, M&A activity was down in the first 6 months, but up in the second 6 months of the election year. Probably that's reflecting increased perceived clarity about the outcome and/or perceived need to accelerate deals before anticipated regulatory or tax changes. And then the third reason is that valuations are more historically realistic, less lofty. So more companies that survive the COVID crisis may pass through buyers' diligence screens. And some are. Some transactions are still happening. Supported by reasons I'll discuss later, I predict that the valuation range that'll close most transactions will return to historic norms, not become a disaster for most sellers. What do investors want? They want companies that are insulated from recession via recurring revenue, proprietary and highly differentiated offerings, technology, patents, or other characteristics of high-quality businesses, such as lack of customer concentration. This is not to say that absent all these characteristics, businesses won't sell, but the more of them, the more desirable the company. Consolidations of fragmented industries, like CMOs, are often the result of well-funded acquirers seeking economy of scale for cost reduction, skills or technologies they don't already have, and/or market power. Over past years, we've seen continual consolidations as acquirers/investors execute buy and build strategies, bolting together companies with different but related market offerings in this business. Medical contract manufacturing has been restructuring for the past few years, largely in response to healthcare system cost squeezing overall. Contract manufacturers are highly fragmented, competitive, and they lack market power. The typical onshore product offering is largely interchangeable prototyping and low to medium volume high mix manufacturing. While it may not be easy to move that once the OEM has established outsourced production, a likely pattern is to hold existing sourcing agreements for more highly engineered, difficult to transfer items, but get fewer and fewer RFPs for new product development, new product introduction business, and follow-on manufacturing runs. Large-scale manufacturing, medical device manufacturers publicly state their intent to pair supply chains, just as the aerospace industry had done before. Shifting to a more strategic sourcing model will lock in relationships, making it harder for everyone else to get contracts. The net effect will be fewer suppliers which gain recurring revenue relationships. Recurring revenue is much more valuable to investors than one-off jobs revenue. And this is not just my speculation, it's discussed pretty freely in trade journals. A widely held prediction for the future of U.S. contract manufacturing, the low-volume, high-mix segment of markets like medtech, aerospace, instrumentation, sensors, and industrials, that's still here and onshore to the U.S., will increasingly be served by super-regional, single-source suppliers serving almost all the OEM's needs from design engineering through production, with offshore manufacturing availability when warranted. As one large device company told a contract manufacturer CEO, the ideal size will probably be somewhere around 50 million to a couple of $100 million in revenue. Big enough to meet our needs, but still small enough to be nimble and responsive to us. Fewer and fewer of today's under 25 million annual sales revenue companies will hang on unless they offer the market something really unique. Here's a half dozen examples of the buy and build consolidations I mentioned, but there are plenty more. The two at the top are publicly traded companies, but all the rest are funded by private equity investors. I know of many of the active strategic and financial investors and track the transactions. Before COVID, I was tracking 144 who said they were looking for, quote, plastic manufacturers, 79 for injection molding, 99 advanced manufacturing, 27 for medical CMOs specifically, 139 for CMOs generally, 32 EMS, and 16 printed circuit board manufacturers. And I know that these numbers are not comprehensive. The result of this is that the market is being populated by a whole new competitive set. As the contract manufacturing industry continues to consolidate, the competition is increasingly becoming private equity funded entities. They're well capitalized, have the board resources of highly professional management, offer a full portfolio of services and production technologies under one brand sometimes, and can serve clients through multiple locations, often domestically and foreign. This trend is why, for the past few years, I've been telling owners that there's a musical chairs dynamic. In that childhood game, nobody wants to be left without a seat when the music stops. Markets change around company owners who don't consciously plan either their capital and operational investment to maintain a competitive edge or plan their exit. Timing really matters. The forces of innovation in a market can either propel a company's growth or shove it aside. It's critical to be aware of the various innovations as a starting point for creating a proactive plan to direct the business to either take advantage of the trend, which typically does involve some investment spending, or consciously decide to avoid doing so for whatever reason. Here are just a few innovations that might have profound influence. I place this section in the unfavorable grouping because many companies will not likely benefit. However, the benefit of this is, or the impact of this is individual company to company. 3D printing technology is increasingly important, having moved from just a prototyping technology. In my opinion, not offering it is a perilous position for most CMOs. A few years ago, I wrote an article saying that, quote, today, 3D is a competitive advantage, but in a few years, a necessary capability, quote. Do you think that's right? Do you think we're there now? According to a study conducted by 3D Hubs in Amsterdam, the total value of 3D printed parts increased 300% last year. Carbon 3D in Redwood City, California is promoting their production efficiency from 1 to 1 million units. Even still, some people say, additive manufacturing is just suitable for prototyping. In the case of some parts and assemblies, absolutely yes. But clearly, 1 million is production scale. BMW had already printed its millionth part a year and a half ago, to my knowledge, and to my knowledge, HP's been working with Volkswagen to scale up into production at least that long. Last year, GE introduced a turboprop engine partly made by 3D printing that reduced testing from 12 to 6 months, weight by 5%, and get this, 855 parts were replaced by 12 printed additively. This was clearly an important validation for the structural integrity of additive manufacturing. The economic benefit's obvious. So, of course, this will be a major driver of change for plastics, mold making, and machining particularly. Though I am not predicting the demise of these, only a new and in many cases diminished role in the supply chain as time goes on. TV didn't kill radio either. It just reallocated the market. Simultaneously, a new business model is emerging, an intended Amazon for precision manufacturing. Just as software as a service, abbreviated SaaS, SaaS, is today's predominant delivery model, these companies are promoting mass manufacturing as a service. This company is 3D Hubs in Amsterdam, I mentioned a moment ago. As you can see, they've got some pretty impressive clients, Audi, ABB, NASA, and HP. They're not the only one establishing this service delivery model. Another is Xometry. which has worked for BMW, GE, NASA, and the US Army. An EMS variant is San Francisco's venture capital funded Tempo Automation, which claims to be the world's fastest electronics manufacturer for prototyping and low volume production of printed circuit board assemblies. From Finland, Taktotech, a developer of injection molded structural electronics, integrates flexible printed circuitry and discrete electronic components in 3D injection molded plastics. Their technology supposedly reduces plastics use by up to 70%, assembly depth up to 90%, reduces the amount of manufacturing tools also by 90% as compared to conventional electronics, reduces the part weight up to 70%, and produces 35% less greenhouse gas emissions. Popular uses include human-machine interfaces with touch controls and lighting, appliances, building automation, and Internet of Things devices and wireless IoT applications. They've raised $23 million from venture capital firm Ascend Capital Partners and 2 strategic investors, partly to expand their presence in the US market. This innovation has significant implications for both plastics and EMS providers. Who would have thought 10 years ago that these companies, Apple, Google, Facebook, Amazon, Sony, Microsoft, would have gotten into the medical device business? As a result, here are a few predictions. Assembly of more complex devices with unlike parts, in other words, heterogeneous assembly, and software integration will become more in demand. Only the most digitally advanced, cost-efficient CMOs will land business from these companies, though. And there will be continued acquisition of medical device companies by these much wealthier IT companies. The public equity market values these companies greater than anything. So they've got plenty of cash to do this. Engineering and prototyping contract manufacturing work for some providers is somewhat driven by venture capital funding, especially in California. Here are a few key facts to summarize where things stand. The deal count didn't drop as far as many had expected because investments in later stage companies largely continued in the first half of this year. In the second quarter, 20% dropped off versus the average quarter over the past 3 years, but relative to expectations, you could almost say that was favorable. Predictably, VC support for early stage companies, probably best described as Series C, Series A, Series B, fell off pretty precipitously in the first half of the year. That's fleeing risk, pure and simple. Implication: fewer new companies in the pipeline may not bode well for future contract manufacturing business. Remains to be seen. Corporate venture capital participation in venture-funded deals rose substantially this year. Again, this suggests that CMOs, which hold tight relationships with corporations participating in VC, in other words, those strategic sourcing suppliers I mentioned a few minutes ago, are more likely to get downstream business from those companies. This also suggests that the corporations which may have flinched at stratospheric valuations before might now be deploying held-back capital. Corporate venture capital investment in healthcare particularly has been especially strong during the COVID-19 pandemic, not shockingly. It's become an important piece of overall R&D, providing access to data and technologies. While some sectors have been heavily affected by the pandemic, many startups, especially in software and biotech sectors, have fared relatively well. There are many investment spending needs to remain at the forefront of advanced manufacturing. The elements on this slide in the aggregate represent what a healthy and market trend resilient CMO will look like in the manufacturing 4.0 reasonably near future. Well-funded companies, whether public like Proto Labs or private equity invested, are heading this direction, if not already there. Those not continually investing will become less competitive day by day, continually eroding value. In manufacturing, a key performance indicator for a factory is overall equipment effectiveness. Current manufacturing says 65% is good, 85% is world-class. Knowing what's happening to the minute detail offers a path to improve this key performance indicator. Increasing the presence, frequency, and accuracy of plant instrumentation is the first challenge, and the economic value of that knowledge is the reason for such a steady growth forecast. This is forecast to generate a lot of electronic manufacturing business over the coming years. It's where manufacturing is going, starting with the largest companies, then moving downstream into the middle market. But there are many other steps in the manufacturing 4.0 journey, such as integration of artificial intelligence to make sense of all this newly gathered information. To address the investment and implementation needs supporting new technologies, many companies turn to private equity investors, whether that's private equity funds or family offices. Almost 30% of US middle market companies have either taken some private equity investment or been acquired by one of the other companies in which the fund is already invested. It's a lot easier to fund growth that way, and the financial upside potential can be fabulous for operating shareholders who stay on board as operators and co-investors. The more PE-funded companies in a given industry, the harder it will be for the other private companies to compete. Shifting gears to owners' demographics, half of the over 5 million private US employer firms in the nation are majority owned by someone 55 plus and 20% by someone 65 plus. Thus, there are over 1 million employer companies ready to change hands, with another 1.5 million queuing up right behind them. It's harder to sell a company for its highest price and best terms when there are a lot of similar companies in an industry on the market. Of course, the more businesses seeking buyers, the more bargaining powers the buyers will have. Simple supply and demand. As this very daunting Moody's Analytics slide shows, there are far more Americans over 65 years old than younger ones. That crossover occurred just after the last recession. The red arrow points to where we are now on the timeline within that gray band, which represents a recessionary period. Notice how the gap has diverged between the yellow line, representing Americans age 65 plus, and the green line, those aged 20 to 64. In this context, they can be thought of as proxies, inclusive of some owners of retirement age and a proxy for US working age population, inclusive of some prospective acquirers. It's not definitive, but could indicate a diminishment of private company exit options as more baby boomer age owners decide to sell into a market that becomes increasingly unable to absorb the volume. Tax law changes. The 2017 Tax Cuts and Jobs Act has a provision that treats interest expense less favorably in 2022 and phases out the ability to expense furniture, fixtures, and equipment started in 2023. The interest expense effect will be unfavorable to net income, which reduces valuation. Yeah, and while deals are typically negotiated using EBITDA as an earnings proxy, net income is certainly factored in too. Quite simply, a company with less net income potential will transact at a lower multiple of EBITDA than one with higher net income potential, logically enough. The more complex advanced manufacturing becomes, the harder and more expensive it is to hire. Having these 5 key skills to support the 4th manufacturing revolution raises the hiring difficulty. Computer skills, robot and automation programming, critical thinking, always useful to have. Working with tools and technologies, digital skills. The forecast number on the right of the slide was before COVID. So what's the implication of this? Half of manufacturing execs surveyed before COVID said that not filling open skilled job positions would hinder their company's ability to meet customer demand. Of course, this would cap growth and inflate wages. Obviously, the dynamic has changed somewhat recently on both the customer demand and labor supply sides. But regardless of labor supply, social distancing caps personnel count too. As an aside, ThomasNet.com, the 120-year-old business-to-business marketplace, now a data and technology platform, commissioned a survey titled COVID-19's Impact on North American Manufacturing. It indicated that 38% of the companies surveyed are actively hiring now, regardless of COVID, or thanks to COVID for freeing up some candidates, however you see that. Skilled labor shortage is predicted to surge demand for manufacturing automation technologies like robotics, though, at least doubling over the next couple of years. This requires significant investment. Again, many companies' technology initiatives will be aided by private equity investors and family offices. That same survey I just mentioned showed a lot of interest in automation. 55% of the participants say they're likely to, very likely, to invest in production performance automation in the next year. Again, it's pay to play to keep up with this market. Now let's shift gears to the favorable factors. I don't even pretend to know how the world will rebalance its geopolitical relationships and supply chains, but do have some insights, a few facts, and emerging trends that may have direct relevance to your business. While finance industry survey respondents worried over tariffs and a trade war in January, I think it's pretty fair to say that the relationship's tone has increasingly moved toward geopolitical conflict and quest for leadership position between the US and China. And that's not just the US-China relationship. Many countries are questioning whether they have let themselves become way too dependent upon China's role within the global supply chain. The COVID PPE shortages and subsequent flood of the counterfeit PPE escalated the priority of that question. On top of that, there are many other increasing concerns for the West, such as China's militarism in the South China Sea, exerting control over Hong Kong, and threat to withhold rare earth element supply as a bargaining chip. In any case, the West's relationship with China is changing. This has direct implications for all USA business, but especially CMOs and EMS companies. The US government's dispute with Huawei is broader than just whether Beijing can use a backdoor in their technology to access proprietary network data, though that concern can't be minimized. Currently, Huawei holds the global leadership position in deployment of 5G technology by a wide margin. Note the word deployment, not to be confused with design and engineering leadership, which we allegedly still hold, albeit tenuously. Obviously, the US doesn't want to cede that to anyone. China, principally Huawei, secondarily ZTE, is aggressively pursuing 5G, building out its 5G infrastructure and embedding the technology in phones faster than the US. It also plans to use demand, consumer demand, to drive its infrastructure by having $300 5G smartphones on the market by the end of this year. I think it's fair to say that there's some state subsidy to get to that price point. China states that their intent is to exert technological leadership in 5G, artificial intelligence, and machine learning. But importantly, they're weaker in semiconductor design and engineering, a key component to get there. And their leading semiconductor foundry, the Semiconductor Manufacturing International Corporation, abbreviated SMIC, S-M-I-C, the world's distant fifth largest, is, for now at least, constrained by US export controls on semiconductor manufacturing equipment, an area in which we're technological leaders. China's investing aggressively, though. The Semiconductor Industry Association says that there are a few must-win future technologies for our leadership and economy going forward: artificial intelligence, quantum computing, advanced wireless networks. which would mean 5G for now, 6G later, 7G, and so forth, I guess. The US and Arizona governments are in talks with Taiwan Semiconductor Manufacturing Corporation, TSMC, the world's largest semiconductor fab by a wide margin, to establish a state-of-the-art US fab scheduled to begin production in 2024. One could expect favorable spillover effects for all the semiconductor value chain participants, including US EMS companies, if it happens. Production cost is an obvious concern, though. This pandemic has accelerated a few existing trends. Business transformation to digitize more and more the enterprise, supporting revenue and productivity initiatives, along with ensuring business continuity, of course. It's particularly beneficial to software companies, but I'd say probably also electronics in the broadest sense. Prioritizing what's essential to build and store domestically to protect supply in case of sudden demand or shortage, especially medical device and consumables, another clear trend. A universal desire to rebuild some US manufacturing, but not protecting legacy technologies, new, digitized, state-of-the-art manufacturing. To that end, the latest Thomas Industrial Survey assessing the ongoing impacts of COVID on North American manufacturing revealed that companies are rethinking their supply chains and operation tactics to prepare for the new normal. That survey revealed 69% of manufacturing companies are looking into bringing production to North America. That compares to 54% who said that in February. The graph indicates monthly responses to the question of how likely are you to bring more production/sourcing back to North America after the outbreak? The red arrows indicate increases in respondents saying likely, very, and extremely likely. They also had strong confidence in the future. 91% of respondents believe that North American manufacturing segment can recover from the pandemic. This survey sample was gathered to reflect the profile of American manufacturing, with an almost 80% identified as either OEM or custom manufacturer, about equally split. My conclusions are some reshoring's likely, some CMOs and EMS companies will benefit, but there is an inevitable unit cost penalty for volume production, which is going to have to be addressed on a case-by-case basis. Since about 40% of those expressing reshoring intent were OEMs, reshoring would seem to benefit domestic CMOs with incremental business. Well down the value chain from semiconductor manufacturing, we know that US contract manufacturing has long been established in Mexico. I expect Mexico to benefit from more production shifting there, and perhaps even other Latin American countries. Interest rates. In response to the COVID crisis, governments around the world reduced the cost of money. Our so-called risk-free rate, the 10-year treasuries, yields less than 0.7%, which is more than a point less than it yielded in January. When the cost for a risk-free investment drops, investors' return expectation threshold for an investment with risk, such as public equities and even more risk, private company equities, that typically drops too. So what this means is that if a company's cash flows may now be less than they were before COVID, that effect will at least mitigate somewhat the damage that would otherwise cause to its valuation. Fiscal stimulus will help deals get done favorably for both buyer and seller, assuming that debt financing is available. While banks are likely to pull back in a recession, they typically do, private debt funds last year were sitting on about $240 billion in investable funds globally and are likely to continue investing through a downturn. Therefore, debt financing is unlikely to dry up to the same extent during the global financial crisis. The flood of private investor capital is the most important factor to owners concerned about their company losing value now. There is a supply and demand imbalance. Yet again, last year, for I'm not sure if it's the 10th year in a row, but probably is, thereabouts anyway, there was a record amount of private equity investment capital raised. That brings us to a total of $1.45 trillion of what's called in the industry dry powder, in other words, investable funds, to spend on companies, private companies. That said, private equity is a GDP-linked business. New fundraising will probably decline now, but still, there's that $1.5 trillion sitting there that needs to be used. In the middle market, this private capital is most often used to fund growth, acquisitions, shareholder buyouts, management team buyout or buy-in, intergenerational family transfer, or majority recapitalizations in which the investor buys a controlling interest, but the operating shareholders continue to run the company with their team to achieve agreed growth goals. In a very few cases, it's used to take public companies private. The pre-existing investor competition for the best companies didn't change. More capital than quality companies in which to invest normally boosts sales prices for the rest, as we've seen over the last several years. Despite this COVID economy, I think that the net effect will be to bring the market back into balance rather than shift all the power to acquirers and investors. The capital flood is why I predicted earlier a market valuation shift to historic norms rather than a hard tack from sellers to buyers market. The investment capital still needs to be spent. COVID didn't change that. Since the finance and investment community was already expecting recession around the corner, they were already favoring companies that would be recession resistant. Coronavirus just reduced the universe of companies that will attract investment, and those perceived as recession resistant will gain favor. MedTech, also known as healthcare devices and supplies, is a good place to be now. Late in 2019, demand for medical manufacturing was already surging, as indicated by supplier search volume on the largest and 120-year-old B2B network, thomasnet.com, now a data and platform company. Notice the categories on the left side of the chart: medical devices, medical device contract manufacturing, and so forth, and then the percent growth on the right. Very significant. Since TSMC, again, Taiwan Semiconductor Manufacturing Company, is the world's largest foundry by far, with the next largest competitor, Korea's Samsung, but Samsung's only a third their size, analysts consider TSMC a bellwether for the electronics industry overall and globally. Well, to analysts recently, TSMC said the overall semiconductor market will be slightly flat to slightly up, during the rest of this year. During the year, growth for the segment that they dominate will be in the mid to high teens % range, while they'll outperform their peers with revenue growth exceeding 20%. They go on to say that in the mid to long term, we believe the underlying megatrends of 5G and HPC applications remain intact. HPC is high performance computing, quantum computing, as I referenced a minute ago in context of Semiconductor Industry Association. I've already discussed the megatrends, but add to them a fresh new one. Home working and home entertainment will become part of the new normal. And this means that there'll be a surge in demand for the technologies which enable computing and communications equipment to work effectively and efficiently. This will drive electronics manufacturing upstream of EMS, but I would expect some downstream flow as well to second and third tier EMS. It's uncertain now whether the previously forecast almost 11% growth rate for medical contract manufacturing will be the right number, but the population trends driving that number in the first place still exist. And we now have new health challenges creating manufacturing demand. For some medtech manufacturers, I think COVID-19 enhances perception of recession resistance. On the other hand, it's harder to operate profitably during recession. not everybody's going to succeed at that. Note that this forecast was for medical contract manufacturing. Another forecast source, IBIS World, which focuses on OEM medtech manufacturing, not contract manufacturing, has stuck with their 3% forecast for medical device manufacturing after a recent COVID-19 research update. The implication, if both sources are correct, is that more medical device manufacturing growth will be going to the outsourced providers than done in-house. The bottom line, what do these trends mean? Well, that really depends on your goals for the next 5 to 8 years. They do suggest grow or go, invest or divest. Running in place is probably not viable. Even in normal times, it's not viable for long. In any case, I'd encourage you to make an active decision, not a wait-and-see decision. That is the highest risk option. I suggest that owners ask themselves, am I going to be better off putting more money into the business to stay technologically competitive and independent, then holding the company long enough to reap the rewards while swimming against industry trends? Or am I going to be better off divesting part or all of the business now and putting the proceeds into a portfolio of diversified investments? As an aside, just something to think about, since 1957, the S&P 500 has delivered an almost 8% average annual return, 7.96 to be exact, with, of course, lots of up and down along the way, but that trend line is solidly established. I keep a quote on my office wall from Andy Grove, who was a co-founder, the CEO, and chairman of Intel Corporation during its greatest growth years. There is at least one point in the history of a company where you have to change dramatically to rise to the next level of performance. Miss that moment, and you start to decline. I suggest that operating shareholders consider the questions. Are we the right people with the right skills to take the company to that next level? Are we adequately capitalized to do so? As shown on this options matrix, owners have 4 basic strategic options, each with a different risk-reward profile. I won't take you through them now, but I will happily do so, of course, if you contact me. Okay, here's the commercial. Don't worry, it's pretty short. How we add value to achieve a successful transaction. Private capital and M&A transactions exist in a broad universe of considerations, as indicated by the graphic to the left. The entire process must factor in each concept in the bubbles, starting with the majority shareholder's personal needs. The points to the right summarize how we add value. I'll briefly go through them. Establishing value is best described as an expected range. A company can have a dozen different values at once, depending upon the objective of the valuation. A formal fair market valuation is only needed sometimes if the company is going to go to market in a competitive process, whether that's a broad or limited scale process. In that circumstance, the market determines the value through a process of price discovery, which typically is higher than fair market value, which is an IRS statutorily defined standard. I'd never show a fair market valuation to a buyer unless they thought the company was worth less than what that valuation stated. Generally, fair market valuation is a floor and only useful for as long as nothing changes. Managing the process will employ a proven multi-step regimen to confidentially lead and manage the process to achieve the highest available value and best terms. Supporting you, we lead the negotiation process and counsel you throughout. Of course, the buyer's needs must be met to move forward. Each one's different, so each negotiation is unique and often simultaneous and time-consuming. Adding credibility to the seller. If the buyer already knows that they're not going to be the only one negotiating for the deal, They'd prefer to have the company professionally represented, as everything goes so much more smoothly and it's more likely to transact and close. Preparing the company for transaction readiness. The depth of that and the duration depends on the company and its needs, but generally speaking, there's a fair amount of management consulting that comes with an engagement agreement with our company, or probably most any investment bank. Most companies are nowhere near as ready for a transaction as they think they are. And contacting buyers, investors, lenders, that's core to what we do. Often companies are sold to or invested in by entities they've never even heard of. Structuring the transaction is a delicate dance that must be especially cognizant of the tax implications. Educating and coaching owners is part and parcel to the process. And then freeing management to focus on growing the company is a key point that maybe sounds like a throwaway point, but it really is quite a time-consuming process. And the owners of the company really do need to be focused on growth, not focused on dealing with all of the process that I've just described in terse form. But sometimes private company shareholders get the idea that they can manage the transactions themselves and save on investment banking fees, value that they're unlikely to capture anyway. In any case, someone's got to do this work. The vast majority of seller-managed transactions fail to complete, and sometimes the owners get so distracted the business declines. As a word of caution, if you've contemplated running a transaction yourself, I'll quote Mark Twain, who said it so well. "A man who carries a cat by the tail learns something that he can learn in no other way." Third-party studies quantify the value professional transaction advisors bring. This slide summarizes one study. The very first set of points on this slide in the top left corner alone suggest that professional transaction advisors create more value than their costs. Add in the other points, and it couldn't be clearer. Better confidentiality protection, less stress, faster, smoother. If you want a higher valuation, you want your company to be sold, not bought. Unlike public companies, private companies require pushing the market to sell equity in an otherwise illiquid market. At any given moment, the trading price of a public stock reflects the market demand for that stock. At any given moment, the market demand for a private company ranges from zero to whatever offer might walk in the door, to the value established by a competitive process in which parties submit offers. Which would you prefer? The key to obtain highest value is a well-executed process that generates competing interest from multiple parties. It's not uncommon for a well-executed M&A process to achieve a sale price of 20, 40% more than the fair market value, maybe even much more. For companies whose assets are principally intellectual property and/or in markets in which only a select few people see the growth potential, it can be a multiple many times over. People scoffed when Facebook paid $1 billion for Instagram as a little bitty company, but nobody scoffs now. They sure got more than their value's worth out of it. Finally, one bit of parting advice. Don't passively await unsolicited offers. Preparation determines who captures company value. Note on the left of the slide the graphic indicating that most private middle market sales are initiated with intention to sell. However, 45% were reactive to an unsolicited offer in this particular survey. That second group would seldom get their full value. On the right is a subset of the documentation those sellers provided the buyers during the M&A process. In reality, the list is a lot longer and more detailed. Part of our process is getting all this organized and ready. If you're not cocked and ready to produce this as part of an organized marketing package available under non-disclosure agreement on demand, you're already losing value as the caller has the upper hand from day one. They're deliberate and determined, playing offense, while your company's unprepared to even play defense. Their interest might wane, or they might realize that they're dealing with a less sophisticated player and negotiate accordingly, and or employ delay or stop-start tactics to throw things off balance. And you can bet that those behind an unsolicited sale inquiry will hope that you'll not invite any other bidders as part of the competitive process. Do you want to know what the statement that'll get you the value you deserve when an unsolicited offer comes in is? Let me give you my investment banker's contact information. When you hire us as your investment banker, that preparation process begins immediately. Together with you, we'll be the ones playing offense, as that's the way to capture the value of your company. Furthermore, we'll usually be able to establish a competitive dynamic, which doesn't exist when a potential buyer calls to express unsolicited interest. Not only does that inquirer hope that you'll not want to shop the company, they'll want to take control of the process to the degree that you'll allow that and add tens of hours a week to your workload, all the while diverting your attention from running the company. If you'd like to have a discussion about this, please call me at area code 415-294-0002 or email me at mdb@mmsib.com. Thanks for sticking with me this far.